Today I'm going to talk about why people have been hit with large and unexpected tax and customs duty charges when buying goods from sellers based in the EU. Throughout January, the papers and media websites have been full of stories about people being asked to pay tax on the arrival of goods. Refusal to pay this tax results in the courier taking the goods away. So what is this so-called Brexit tax, and why is it being charged when the UK and EU have agreed a zero-tariff Brexit deal? Let's look at the tax position before the end of the transition period, and then consider how this has changed now that the UK has fully left the EU. On cross-border sales of goods, two types of tax are potentially chargeable: VAT and customs duties. Before the end of the transition period on 31st of December 2020, the UK remained in a customs union with EU member states. This meant that there were no customs duties levied on goods passing between the UK and EU member states, and that no customs paperwork or checks were needed on such movements. The pre-Brexit VAT position depended on the amount of sales that the EU seller had in the UK. Let's consider the example of a French business, Cezouge, who sells clothes to UK consumers. Charlotte bought a jumper from Cezouge in November. In order for there to be UK VAT on the sale of the jumper, the place of supply of the goods needed to be in the UK. If Cezouge's annual UK sales were below the UK distance selling threshold of £70,000, the place of supply of the goods would be in France, meaning that French VAT rather than UK VAT would have been chargeable on the sale of the jumper. If, instead, Cezouge had annual UK sales above £70,000, then the UK's distance selling rules would have kicked in, so that the place of supply was in the UK, meaning that UK VAT rather than French VAT would have been chargeable on the sale of the jumper. In both scenarios, VAT would have been charged at the point of sale, the checkout stage of the online transaction. As French VAT and UK VAT are both 20%, Charlotte wouldn't have noticed any difference. Let's look at the position now that the UK is fully out of the EU. The main tax impact on sales of goods to UK consumers is that customs duties and import VAT are potentially chargeable. The tax position depends upon whether the total value of the sale is above or below £135. Transactions below £135 are exempt from customs duty and import VAT. Sophie buys a pair of jeans for £105 from Cezouge in January. As the value of the transaction is below £135, no customs duty or import VAT is payable. Instead, a new place of supply rule provides that the place of supply of the jeans is in the UK. This means that Cezouge is required to register for UK VAT and charge UK VAT on the sale of the jeans. This new rule applies to all non-UK businesses selling to UK consumers and will also require businesses located in third countries, for example the USA, to register for and account for UK VAT on their sales to UK consumers below £135. What if Sophie had bought a belt for £75 as well as the jeans, taking the transaction value to £180, which is above the £135 import VAT and customs duty threshold? Let's look at customs duties first. Although the Brexit deal between the UK and EU provides for zero tariffs, this only applies to goods made in the EU or the UK. Whilst the belt was made in Italy, the jeans were made in Morocco. Because the total value of the transaction is over £135, customs duties are chargeable on the non-EU origin goods, the jeans, but not on the EU manufactured belt. Now, let's look at the VAT position, which is unfortunately rather complicated. There will always be import VAT at the standard UK rate of 20% on the arrival of the goods in the UK. Liability for the import VAT hinges off who is liable for the customs duty. The person liable for customs duty is the person whose name is on the customs declaration, also known as the importer of record. This is agreed contractually between the parties to the transaction. It is usual on a business-to-consumer transaction for the consumer to be the importer of record, which means that the consumer will be liable to pay both customs duties and import VAT on the arrival of goods in the UK. Turning back to our example, if Sophie is the importer of record, she will be liable to pay import VAT at 20% on both the jeans and belt, as well as customs duties on the jeans. Where the customer is the importer of record, the VAT place of supply rules provide that the place of supply is outside the UK, meaning that no UK supply VAT is chargeable. What if instead Cezouge was the importer of record? Then Cezouge would be liable for import VAT and customs duties on the transaction. However, in this scenario, the VAT place of supply rules provide that the place of supply is in the UK, meaning that Cezouge would be required to register for UK VAT and charge VAT on the transaction. Although the transaction gives rise to two VAT events, the import VAT and the UK supply VAT, Cezouge should be able to recover the import VAT as input tax, meaning that the customer shouldn't bear the economic burden of two slices of VAT. So why have some EU businesses been getting into such a muddle? How can consumers have been subject to double VAT on transactions, firstly at the checkout, and secondly on the arrival of the goods? I think some businesses may have been continuing to charge local VAT, not realising that now the UK has left the EU, the export of the goods should be VAT exempt, meaning that no local VAT should be chargeable. Others may be struggling to apply the complex UK VAT place of supply rules and charging UK supply VAT on a transaction, as well as leaving the customer to pay the import VAT, which is not correct. What are the different options for EU businesses going forwards? On transactions below £135, they don't have any options. They will have to register for UK VAT and charge UK VAT on these sales. On transactions above £135, they could continue to let couriers collect import VAT and customs duties on the delivery of goods, but customers don't much like being hit with unexpected tax bills. As there is no local VAT on the sale, the customer should only be subject to one slice of VAT on the transaction, which can be collected at the checkout stage. If the customer is the importer of record and liable to import VAT, the business can arrange for this VAT to be paid on behalf of the customer on the entry of the goods to the UK. That leaves customs duties on goods with a non-EU origin. Either businesses can carefully track which of their products are subject to customs duties and levy this at the checkout, or they could raise the price of all goods sold to UK consumers and use this to fund the payment of customs duties. Either option has the advantage of ensuring that the customer has transparency of pricing at the time of the transaction and won't be subject to unexpected charges on the arrival of the goods. Another option for businesses with more substantial UK sales would be to set up a UK warehouse and to pay customs duties on the import of goods into the UK, but not on subsequent sales to UK consumers. Finally, if there is no UK warehouse, businesses will need to consider the operation of their returns process, as customs paperwork will be required on the return of goods to the EU warehouse.